They said this was the dawn of a new intelligence, a gold rush without end. Money raced in, $100 billion for Silicon dreams, fortunes gambled on code that promised to think. But more compute only fueled illusion. Behind every glowing headline lay a secret. Empires can be built on deception, and the world has fallen for this before. South Sea, .com, housing, crypto. Each collapse left scars, but hope always returns in brighter packaging. Why do we chase these mirages? Tonight, the untold story of the AI bubble reveals how faith becomes greed and how the biggest scam in tech history took hold, right in front of us. Chapter title: 2 minutes to 6 minutes. The Dream. Historical echoes. Scene directions. Golden light on old prints and modern servers. Slow pan from sepia engravings of coffee houses to neon cityscapes, then to close-ups of hands-on keyboards and weary faces. Ambient piano and low synth build beneath narration. Speculation is as old as money. In the summer of 1720, London's coffee houses overflowed with talk of the South Sea Company. Shares soared 1,000% on promises of untold riches from distant oceans. By autumn, fortunes vanished. The company's stock collapsed by nearly 90%. In its wake, ruined families and silent streets. The lesson carved into the city's memory. Dreams can turn to dust in a single season. Centuries later, a new mania swept the world. The dawn of the internet, the .com boom, drew crowds to glowing screens and ticker tapes. Companies with little more than a name ending in .com traded at impossible heights. Fiber optic cables blanketed continents, most destined to remain dark and unused. When the crash came in 2000, NASDAQ fell 78%. $5 trillion lost. Behind every chart, lives were upended. Retirements postponed, homes sold, hope deferred. The scale felt impossible. In 2008, the world watched as bankers bundled risk into alchemy. Mortgages were transformed into gold, or so the story went. S&P 500 tumbled 57% from its peak. The collapse erased over $15 trillion in global wealth. Trading floors emptied overnight. The silence that followed was heavy, a reminder that faith in numbers can be as fragile as breath. The myth of alchemy had a human cost. Even the digital age was not immune. Cryptocurrencies, once hailed as the future of finance, soared to a market cap of nearly $3 trillion in 2021, only to plunge 77% within a year. Online forums filled with disbelief and regret, as investors tracked the shrinking value of coins that just months before had promised freedom from the old order. Each era follows the same pattern, crowds chasing a new dawn, convinced this time is different. Each time, the ending is written in numbers. Losses so deep they redraw the map of power and trust. The cycle repeats, not because we forget, but because belief is stronger than memory. The South Sea pamphlets, the .com IPO lists, the mortgage-backed CDOS, the crypto white papers became artifacts of optimism, now relics of collapse. In every bubble, the crowd is the main character. Hopes pooled together, then scattered by panic. The scars left by these crashes run through economies and families, shaping how we dream and how we fear. And always, as the dust settles, a new story begins to form. Brighter, louder, promising that this time, it will be different. Ending reflection. History doesn't repeat itself. It reminds us. A single phrase can move billions. Don't miss out. In every era, the crowd's heartbeat is the same. Investors gather not just for profit, but for belonging. The lure is not only wealth, but the feeling of being ahead, of glimpsing the future before anyone else. In 2023, a global survey found that 87% of Fortune 500 executives believed artificial intelligence would define the next decade. Headlines declared a new arms race. Boardrooms filled with urgency. If your rivals were building AI, you had to build faster. If your neighbor bought in, you feared being left behind. The mechanics of belief are ancient, but the tools are modern. Social feeds pulse with stories of overnight millionaires, of startups raising hundreds of millions with a single demo. Venture capitalists compete for access, not diligence. The more crowded the room, the more irresistible the invitation. FOMO, fear of missing out, becomes a business model. In 2025, two-thirds of all U.S. venture deal value flowed into AI and machine learning startups, a leap from less than a quarter just 2 years before. Prestige is contagious. When Harvard, Stanford, and MIT launched new AI institutes, corporate donations soared. When NVIDIA's market cap passed $1 trillion, it was not just a number, it was a signal. The world's most powerful institutions had placed their bets. Investing becomes a ritual of faith. The promise is that data and compute will conjure destiny. To hesitate is to risk irrelevance. The pressure is not only external, but internal. Careers, reputations, even friendships are tied to the next breakthrough. In private, some executives admit they do not understand the technology. But to question the narrative is to risk exile from the future. Cultural mantras echo through every pitch deck and press release. Disrupt or be disrupted. Move fast and break things. The next trillion-dollar company is just an algorithm away. The crowd's optimism is self-fulfilling. Valuations rise because everyone believes they must. Every bubble is a mirror, reflecting our hunger to belong to the winning side of history. The result is a tidal wave of capital, chasing the illusion of inevitability. In the end, what moves markets is not code or hardware, but human longing. The need to believe that this time, belief itself will be enough. Chapter 3. The Machine. Financial Gears. 6 minutes to 15 minutes. A single chip became the fulcrum of $1 trillion illusion. In 2024, NVIDIA's H100 GPU was not just hardware, it was a passport to the future. The world's most powerful companies scrambled to secure supply. Each contract read like a declaration of faith, that artificial intelligence would deliver on its promise. But behind the headlines, the machinery of the bubble was engineered in boardrooms and legal offices, not in code or silicon. The gears turned on promises, not profits. NVIDIA, Oracle, OpenAI, and AMD entered a web of deals whose complexity rivaled any Wall Street invention. In September 2025, NVIDIA pledged $100 billion worth of GPU to OpenAI, not in cash, but in hardware to be delivered over years. The value recognized long before a single chip reached a data rack. Oracle, eager to anchor its place in the AI arms race, committed to buy $40 billion in NVIDIA GPU, funding the purchase with an $18 billion bond issue. The chips were meant to populate a constellation of data centers, built not for current demand, but for the expectation that tomorrow's AI would require an empire of compute. These contracts carried the weight of certainty. Minimum purchase guarantees locked buyers into decades-long obligations. Oracle's 15-year leaseback with OpenAI meant revenue could be booked as soon as ink dried on the agreement, even if the data centers stood empty. SEC filings listed future lease payments as assets, transforming unbuilt infrastructure into immediate value. In that accounting, risk was not erased, it was postponed, hidden in footnotes and the fine print of bond prospectuses. Equity and hardware blurred into a single currency. OpenAI's deal with AMD included a warrant for future ownership, contingent on hitting usage targets. If OpenAI bought enough GPU, it could claim a stake in its own supplier, tightening the circle of incentives. Microsoft and Amazon poured billions into cloud infrastructure, securing guaranteed customers and future lease income. Each player became buyer and seller, lender and borrower, balance sheets swelling with promises to one another. The numbers grew monstrous. Oracle's $300 billion contract pipeline, Meta's $60 billion in annual infrastructure commitments, NVIDIA's $100 billion in hardware credits. Each figure echoed the same assumption, that exponential demand would never falter. Off-balance sheet obligations multiplied, their true scale visible only to those willing to read beyond the headlines. Lease agreements, purchase guarantees, and equity swaps stitched together a synthetic demand, as real in the eyes of the market as any physical shipment. But the foundation was brittle. The revenue recognized in quarterly reports depended on contracts, not consumption. If demand slowed, if a single partner hesitated, the web could unravel. Bond investors, drawn by the lure of future lease payments, underwrote the expansion, trusting that AI would fill every server rack. In private, some treasurers whispered concerns. What if the assets depreciated before the world caught up? What if the future was already priced in? The illusion was self-reinforcing. Each new deal became a signal, a reason for the next round of investment. SEC filings and earnings calls spoke of pipeline strength, not present need. The machinery of the bubble was a perpetual motion device, powered by contracts, fueled by belief and lubricated by debt. The gears spun faster, each turn tightening a risk no one dared to name. In the end, what passed for demand was often just obligation, an agreement to buy, a promise to lease, a bet that tomorrow would be as hungry as today was hopeful. The financial gears ground on, indifferent to the brittleness beneath. The world watched the numbers climb, unaware that the engine was running on credit, not conviction. Scene directions and visual notes. Golden light on server blades, close-ups of chips, slow pull back to empty data halls. Cutaways to legal pads, signatures, bond prospectuses highlighted in slow motion. Graphs climbing on trading screens, then trembling as if on the verge of collapse. Faces in reflection. CFOs, engineers, custodial staff, families watching headlines. Ending reflection. The machine looked like progress. It was, in many ways, a promise factory, but promises can be booked and they can be bought. They cannot always be delivered. End of Act 3. The promise of artificial intelligence was staged in polished rooms, under perfect lighting, with every flaw rehearsed away. Deimos dazzled audiences, machines writing poetry, diagnosing illness, composing music in real time. Investors leaned forward, notebooks open, believing they had glimpsed the future. But behind the curtain, the story was different. At CES 2024, a headline demo of an AI assistant stuttered off script. Internal quality assurance logs, later leaked, showed the system had failed every third prompt in rehearsal. The public never saw these moments. Instead, what reached the stage was a carefully edited illusion, as choreographed as a Broadway show. At TED 2024, a model wrote an essay live, but the text had been seeded in advance. The input tweaked until the output matched the script. In the days that followed, researchers pored over the footage, comparing it to internal bug reports and finding a pattern. The more spectacular the claim, the more likely the demo was rehearsed, not real. Beneath the spectacle, the technical foundation began to fracture. In early 2024, a team led by Shumailov published a study in Nature that sent a chill through the research community. They showed that when generative models are trained on their own outputs, recursively, generation after generation, something subtle and irreversible happens. The rarest signals, the outliers, the edge cases that make human language rich begin to vanish. After just a few cycles, the model's world shrinks. Its answers grow more generic. Its creativity collapses into cliché. The study's graphs revealed a steady erosion. Variance, once wide and wild, collapsed into a narrow band. Coverage of rare tokens, words and ideas that fall outside the mainstream, dropped to near zero. In the margins of the paper, a warning: the more we let models learn from themselves, the less they remember of us. The problem ran deeper. Benchmarks, the gold standard for measuring progress, were no longer clean. Popular datasets like GSM-8K and AG News had leaked into pre-training corpora, sometimes word for word. When models aced these tests, it was often because they had already seen the answers. Replication studies stripped away the contaminated questions, and performance fell by as much as 20%. The illusion of progress built on memorized benchmarks began to unravel. In private, engineers spoke of a house of mirrors, where every new model seemed smarter, but only because the test had been rigged by history. Inside the labs, the mood shifted from celebration to caution. Red team reports flagged hallucinations. AI systems inventing facts, citing papers that did not exist, or making confident mistakes in high-stakes settings. In hospitals, customer complaints spiked as chatbots drifted off topic or missed subtle symptoms. In finance, regulators demanded explanations for why models gave different answers to identical questions, days apart. The same story repeated. Outputs grew brittle, trust eroded, and the gap between demo and reality widened with every update. Yet the public face of artificial intelligence remained radiant. Investor decks featured cherry-picked metrics with footnotes buried in technical appendices. Marketing teams extrapolated from contaminated benchmarks, promising capabilities that evaporated under scrutiny. The world saw the highlight reel, never the outtakes, never the drift, never the slow collapse at the edges of the map. The technical mirage persisted because it was profitable. Each new demo, each benchmark victory, justified another round of funding, another wave of hardware orders, another headline about the coming revolution. But the evidence was mounting in Nature articles and internal memos, in variance graphs and user complaints. The machinery of belief was running on borrowed time, and those closest to the code could already see the cracks forming beneath the polished surface. On March 14, 2025, the first real fracture appeared. It did not arrive in a headline. It arrived in a regulatory notice time-stamped just after midnight. A terse bulletin from the European Medicines Agency landed in hospital inboxes across the continent. The subject was immediate review of all AI-assisted diagnostic systems. No details, just a warning and a deadline. Within hours, whispers of liability rippled through the health sector. Compliance officers called emergency meetings. Boards demanded risk assessments. The promise that AI would save lives was now shadowed by doubt. If a machine failed, who would answer for it? The panic did not begin with a single patient or a viral video. It began as a shift in tone, a regulator's language suddenly cautious, hinting at incidents not yet public. Hospital administrators scoured incident logs. Insurers flagged new exclusions. Every line of code, every model output, became a possible point of failure. The illusion of infallibility, built over years of staged demos and glowing case studies, began to unravel in the face of legal risk. By dawn, global markets had taken note. Health tech stocks, once buoyed by claims of revolution, fell sharply at the opening bell. Investor hotlines jammed with calls from funds demanding exposure reports. In San Francisco, the CEO of a leading AI triage startup fielded a dozen calls from hospital clients before breakfast, each one asking the same question: if something goes wrong, who pays? The language of faith shifted to the language of liability. Internal memos from major insurers circulated, outlining new terms. AI errors would no longer be treated as force majeure. Hospitals would bear responsibility for outcomes, even when decisions were made by algorithms. The shift landed hardest in boardrooms, where risk managers tallied exposures and legal teams drafted disclaimers. We are not banning AI. We are demanding accountability, a senior regulator said in Brussels. The words sent a chill through an industry built on the promise of hands-off automation. For years, executives had spoken of AI as a partner. Now it felt like a potential adversary in court. In the hours that followed, the panic spread beyond healthcare. Financial analysts flagged the regulatory notice as a canary in the coal mine. If liability could shift in medicine, it could shift anywhere: banking, insurance, logistics, consumer tech. The risk stopped being abstract. It was written into contracts, priced into insurance, and calculated in risk models. On trading floors, screens flickered with red. AI infrastructure providers watched valuations slide as clients paused deployments. Venture capitalists called emergency meetings, reviewing exposure to startups whose business models depended on regulatory blind spots. The first fracture had opened not with a crash, but with a question. What happens when the promise of AI meets the reality of risk? The world had glimpsed the other side of the dream. This was the AI bubble of 2025, echoing the dot-com crash, 2008, the South Sea bubble, the crypto collapse. The sense of certainty that had powered a trillion-dollar surge was gone. The illusion was no longer safe. The machinery of belief began to grind in reverse, and the silence that followed was filled with the sound of risk being recalculated everywhere. Chapter title: The Collapse, Market Unraveling. Time frame from 15 minutes to 25 minutes. April 30th, 2025. The air on Wall Street was thick, the kind that settles before a storm. At 2:02 p.m. Eastern Time, the Synapse X analyst call began. Routine at first. Screens flickered with the company logo. Traders idled, waiting for the numbers. In the background, chat messages from desks in New York, London, Singapore asked, "How bad is it?" and heard the chief financial officer is spooked. At 2:17 p.m., the mask slipped. The chief financial officer said, to be candid, "We have seen a marked deceleration in hyperscale orders since mid-March. The projected run rate for quarter 2 is now well below quarter 1. This reset is not short-term noise. It is a new baseline." The chief executive officer followed, voice steady but brittle. He said, "We believe the market has been overheated. Some partners are reevaluating their roadmaps, and our expectation is volatility possibly for quarters ahead." A silence opened. 25 seconds, measured in shallow breaths and the hiss of open microphones. The silence on trading floors felt endless. Then the first sell orders hit. Volume surged threefold in minutes. Nvidia, Oracle, Meta, all got dragged into the undertow. Internal trader chats captured the panic in real time. Messages read, "Dumping everything. Stop loss triggered. It is over." Within the hour, Nvidia's stock fell more than 8%. Palantir and other AI darlings followed. The ticker tape bled red across continents. At 2:22 p.m., chat logs showed disbelief turning to resignation. This is .com all over again. But the collapse was not just numbers on a screen. Insider trading records surfaced in SEC filings. Days before the call, Nvidia director John S. Shuey had sold 90,000 shares, $61 million cashed out. The chief financial officer, Lisa Park, had sold 45,000 shares, $30 million gone before the slide. At Palantir, 2 directors unloaded 200,000 shares. These were not the moves of believers. These were exits made in silence, before the crowd could sense the rot. Analysts dialed into the call replay searching for hope in the tone, in the pauses, in the language of executives who once spoke only of growth. There was no comfort, only the cold math of deceleration, contract minimums, and demand that had already been spent. The MIT report released weeks later would confirm what traders already knew. $30 to $40 billion poured into generative AI, 95% of organizations seeing nothing in return. The future had been mortgaged, and the bill had come due. On trading floors, the illusion burst in real time. Faces lit by the glow of monitors, hands frozen above keyboards, the sound of 1,000 dreams unwinding. The crescendo ended not with a bang, but with a truth line that settled over the room like dust. It did not collapse because it failed. It collapsed because it lied. Then for a moment, there was only silence. The machinery of belief had ground to a halt. The reckoning was complete. Visual notes. Slow pullback on a trading floor, golden light turning to cold blue. Cut to close-ups of chat messages, then to exchange screens flooding red. Intercut archival footage of .com frenzy and data center interiors. End the act on a still shot of an empty trading desk, dust motes in a shaft of light. Ending reflection. History does not repeat itself. It reminds us. A badge clipped to a backpack, a half-filled coffee mug left on a desk, an unread email in the outbox. This is how the end arrives for an engineer named Priya. Her badge stopped working on a Monday. The company had once promised her a future built by code and courage, but the vision outlasted the funding. Overnight, the team shrank from 80 to 12. Her goodbye was a silent click in a Slack channel. She was not alone. By May, more than 40,000 jobs had vanished from AI startups across California, Texas, and Berlin. HR emails, once filled with pep talks, became lists of severance details and Cobra. Links. The layoffs rippled outward. Contractors, data labelers, recruiters, each one a name, a family, a plan interrupted. Across town, an investor named Thomas watched his inbox fill with notices. Portfolio companies missing payroll, founders asking for bridge loans that would never arrive. 2 years earlier, he had written checks at midnight, convinced he was seeding the next revolution. Now, the numbers told a different story. Half his investments were worth less than the cash he'd put in. The largest, a generative AI unicorn, had tripled its headcount in 2024, then cut 70% in a single week. The office plants wilted in empty lobbies. The founders, once fixtures on conference stages, stopped returning calls. A spreadsheet can tally losses, but it cannot measure the weight of hope deferred. Priya's parents had celebrated her job at the company's IPO party. Thomas's daughter once wore a company t-shirt to school for show and tell. Now, the stories are quieter. A resume rewritten, a mortgage reconsidered, a friendship strained by unpaid debts. These are the costs that never appear in quarterly reports. The illusion of progress, when it shatters, lands on ordinary lives. The pain is measured in missed birthdays, in the silence of a phone that does not ring. For every chart that falls, there are faces behind the numbers. Engineers, investors, families. The reckoning is not only financial, it is personal, and it lingers long after the headlines fade. The first response came not from the trading desks, but from the institutions tasked with explaining the aftermath. In August 2025, a MIT research group released a report that cut through the fog. $30 to $40 billion spent on generative AI, with 95% of enterprises seeing no measurable return. The numbers, once hidden in quarterly optimism, now stood in stark relief. Policymakers took notice. Draft legislation circulated through congressional committees in Washington and the European Parliament in Brussels. The proposals were precise: mandatory audit trails for AI system claims, public disclosure of model error rates, and new rules tying executive compensation to actual product performance instead of projected growth. Economic analysts pored over the MIT tables, tracing the gap between investment and outcome. In the US, the Congressional Budget Office flagged a shortfall. Projected AI-driven productivity gains had failed to materialize, leaving a multi-billion-dollar hole in public and private forecasts. Bill 4823, introduced in the House, called for a moratorium on federal AI procurement until independent audits could verify claimed capabilities. In Europe, amendments to the AI Act proposed fines for misleading performance statistics and required annual third-party evaluations of high-impact models. University think tanks, once flush with corporate donations, published sober retrospectives. An Oxford policy brief warned that the AI sector's return on investment now trailed even the late-stage dot-com era, where fiber optic cable had once been laid only to go dark. Benchmark, a technology analytics firm, released a chart showing that for every $100 poured into AI startups since 2023, less than 5 had produced sustainable revenue by mid-2025. The language of reform was unmistakable. Accountability, transparency, and performance replaced the mantras of disruption and scale. The reckoning was no longer confined to the market. It had become institutional, a call to measure progress not by promise but by proof. Today, billions in AI infrastructure sit idle. Unused code, empty promises, and power grids strained for profit's ghost. As markets chase new illusions, the true cost is trust in our systems, in progress itself. History doesn't warn, it waits. If we forget how easily we build castles on sand, tomorrow's collapse will echo even louder. In the end, every bubble leaves a vacancy, where belief once lived and where truth must finally return.